Hello and welcome to this final installment for this semester of the Chinese Business History webinar here at the Hong Kong Institute for the Humanities and Social Sciences at the University of Hong Kong. My name is Kelson-Land. I'm one of the co-conveners of the Chinese Business History cluster here at the Institute, and I'm also joined by my colleague, Professor John Wong, who is also a co-convener of the cluster. Today, we are very happy to welcome to the Chinese Business History webinar, Dr. William Kelson, our own colleague from HKU. Dr. Kelson received his PhD from the University of Georgia and is now a fellow at the HKU Society of Fellows at HKU, where he's primarily at the moment working on his first book, which is a wide-ranging study of the financial crises that China saw in the 1880s, and it's really a global history of this crisis. And today he's also going to talk about that in his talk to us, so we're very glad and happy about that. His talk is entitled "Land Mania: The Hong Kong Housing Bubble of the 1880s." Before I hand things over to Bill, I will just say that the format is as usual. So we'll have around 30 minutes of presentation, and then we have some time for Q&A. If you have any questions for Bill, please submit them through the Q&A button in Zoom, and then I will read them out during the Q&A for Professor Kelson to respond to. But I don't want to take up any more time. So, Dr. Kelson, if you're ready, please feel free to get started.
Let me just get my PowerPoint up here. Let's see. Screen. One second, everyone. Thank you for waiting. Oh no, it's not sharing the screen like it was before. So sorry, everyone. We did practice this beforehand. This must work differently when we're recording. Okay, folks, sorry for the awkwardness. You might just have to bear with my notes today. Oh, and now I can't get back to the meeting. We're coming soon.
Sure, no problem.
Okay. Oh, at least we're moving here.
I think you might be able to change it to the other screen now that shows your presentation only.
Yeah, I thought so too, but it's only the same thing that I tried last time that was showing that is not showing it anymore, unfortunately.
Nice.
Let's try one more time and then I'll stop wasting everyone's time. Aha, we did it. There we go.
There you go. Good.
Success.
Yes.
The professor's rite of passage. Sorry, everyone. Okay, so thanks for having me. Thank you to Ghassan and John for having me on. I'll start my talk by saying that I'm here to discuss an episode in Hong Kong history, but I am not, by training at least, a Hong Kong historian. So my interest in late 19th century Hong Kong stemmed originally from a sort of puzzle that I confronted when researching the dissertation and now book that Ghassan mentioned on the Chinese financial crisis, and particularly the late Qing financial crisis of 1883. So that crisis began in Shanghai and then spread all across commercialized China in the mid-1880s, but it was preceded by a housing market collapse in Hong Kong in 1881. As I conducted my research, I noticed that contemporary observers often drew connections between the 1883 Shanghai crisis and an 1881 crisis in Hong Kong. But the exact nature of that connection wasn't exactly clear either to them or to scholars since. So in an article that I published in Business History, and now in a longer chapter for my book, I've attempted and am attempting to establish the sort of precise place of Hong Kong's so-called land mania, as people said at the time, in the wider history of the Chinese financial crisis of the 1880s writ large. Methodologically, one way I've tried to do that is to reconstruct the history of this Hong Kong housing bubble of 1881, as well as the concurrent Shanghai housing bubble, by comparing the dynamics of these particular boom busts to the dynamics of real estate boom busts throughout the history of global capitalism. Without belaboring the theory too much, it's worth sketching out some of the basic phases, I think, of classic or archetypal property cycles, insofar as they do pertain to Hong Kong. The key point I'd make is that asset price bubbles in real estate, that is, when the price of real estate skyrockets quite quickly, irrespective of any underlying fundamental drivers of economic growth. Asset price bubbles like this in real estate are not actually typically manias, as it were. They are often the culmination of 20 or even 30-year cycles of urban growth driven by underlying economic fundamentals, at least at first. In other words, we're not talking about Bitcoin here or something. We're talking about tangible, real property and urbanization. More specifically, the underlying economic fundamental in question that drives housing booms is in-migration, or an influx of people to burgeoning cities of industry and trade, all of whom need places to live and places to work. So that this 20 to 30-year cycle is visualized here. And you'll see that this is stylized, of course, but based on a lot of history and theory. You'll see that real estate prices will often initially lag behind demand in a so-called shortage phase. Then in a longer boom phase, real estate prices will catch up to demand as developers and contractors build out units to house people and businesses, and cities grow. Then, thanks to sort of looser and looser credit facilities that are granted to builders and property speculators, prices will eventually exceed demand. Real though it is, overbuilding will ramp up, and an asset price bubble will finally inflate. Lastly, the bust will come, particularly at the time when loans extended against real estate collateral become non-performing loans, and prices deflate, as a bankruptcy wave will crash over a given city, or sometimes even a wider economy. This is obviously extremely schematic, but when it comes to Hong Kong, the question for me was, and still is this 1881 crisis in Hong Kong a short-lived mania, or sunspot, as contemporary economists sometimes call it, unconnected to long-run dynamics like the ones I've just described, or was it an underappreciated building boom in Hong Kong, perhaps one that was connected to a wider commercial boom in late Qing China as a whole? To answer that question, I've drawn on qualitative and quantitative records from the Colonial Office, some pictured here, as well as newspaper reports, issues of the Hong Kong Government Gazettes, and what sparse data we do have to try and reconstruct not just the 1881 crisis narrowly, but also the entire Hong Kong property cycle, which lasted, I argue, from about 1866 through to the mid-1880s. Critically, as I've argued in the manuscript, there is evidence to show that the period from the end of the Taiping Rebellion in China, so 1865, until the 1883 financial crisis, was in fact an underappreciated export boom in China, particularly for exports of Chinese teas and silks. I don't have the time to lay that argument out in full here, but suffice it to say that over these decades, sailing ships and junks were supplanted by steamships in Asia, thanks to the opening of the Suez Canal on the one hand, and on the other to the invention of the double boiler steam engine, which of course meant you had steamers going back and forth instead of sailing ships. Insurance rates dropped, cargo capacities went up by a lot, and there was more capacity to engage in trade globally. Japanese historians of Asia writ large will sometimes call this a traffic revolution, Asia's traffic revolution. And what it did in China was to underpin an export boom, which itself underpinned urban growth of port cities. German historians will sometimes call this the golden age of the global ports. In China, that was mostly treaty ports, especially Shanghai, but it also included colonial Hong Kong, whose commercial economy blossomed along with the China trade. To put some numbers to the point, between 1869 and 1882, the annual tonnage passing through Hong Kong roughly doubled, increasing from about 2.5 million tons to 5 million tons. Some of this increase was in junk freight from about 1.4 to 1.8 million tons, but the main driver of tonnage growth was steamer traffic, which rose from about 1.15 million tons to 3.2 million tons, again, between 1869 and 1882. Another good indicator of this change is a demonstrable uptick in the number of guild-affiliated merchant firms in Hong Kong in the 1860s and 1870s. So just in the 5 years from 1876 to 1881, for example, the total number of trading houses in the city rose from about 280 trading firms to about 2,377 firms. Many of these were trading companies that specialized in either the Southeast Asia trade or the San Francisco trade. Oh, excuse me. But the largest percentage increase came from merchants of what in Mandarin would be called the Nanbei Hong, or in Cantonese is the Nampak Hong. Forgive my Cantonese, I'm primarily a Mandarin speaker first. And this guild's wealthy trading houses mostly made their money, of course, in the China trade. So far as real estate is concerned, all of this commercial growth ultimately led to urban growth. Put another way, this was an era when Hong Kong really became a sort of magnet of in-migration. And that in-migration came not just from traders, like the ones I've mentioned, but also of working people from across the Pearl River Delta. Porters, artisans, shopkeepers, sex workers, so on and so forth. According to the census data, the population of Hong Kong grew steadily in this period in a roughly linear fashion, from about 120,000 people in 1872 to about 160,000 people in 1880. And crucially, pretty much all of these new migrants who needed housing and therefore underpinned a building boom, most of them were ethnically Chinese, which will become important. All right, so to house all of these newcomers in the 1860s and 1870s, Hong Kong builders and contractors built block after block of this sort of housing. These are the tonglao. And the building boom that ensued in this period was essentially the first heyday of the tonglao. Here, this is Taiping Shan today in Hong Kong, which at the time was a sort of restrictively zoned area for this particular kind of structure. So tonglao, like the ones you see, blended Chinese architectural styles. You'll note the tile roofs, as well as certain Western features, and then sort of shrunk these down for the spatial constraints of a city like Hong Kong. The end product was 2, 3, and sometimes 4-story shop houses, as people called them, with shops on the ground floor and apartments on the upper floors. Oftentimes, landlords would also subdivide these apartments, the upper floor apartments, to house what was a very transient population of working people. And this led, in the worst cases, to overcrowding. But it also meant more rents for merchant landlords. It's worth saying here that this kind of subdivision is quite characteristic of archetypal property cycles. It's something you read about a lot. But in the Hong Kong case, it wasn't just subdivisions that increased rental incomes. It was actually the increased building of these structures. So the number of tonglao in Hong Kong roughly tripled over the 2 decades we're talking about here, according to the estimates of the eminent Hong Kong historian, Cecilia Chu. So nowadays, as Professor Chu has written about, Hong Kong people have preserved those few remaining tonglao that are here as objects of nostalgia. But at the time, the colonial government often actually fretted about what they saw as tenements. Sometimes they would fret about them in a sort of generous way, a la a modernizing urban planner But other times they'd fret in a more explicitly racist way, a la colonists who worried that their white-only neighborhoods might be engulfed by all these new Chinese migrants. Their racism aside, the Tonglao, as in so many construction booms in property cycles past and present, were unfortunately often shoddily built structures, or at least not as well built as previous types of Chinese structures. Builders and developers in the period regularly threw these up quite quickly, first, of course, to meet demand, but then later in the cycle, they'd overbuild ahead of demand. You'll see this is an example from 1882. In the image here, a couple of things to note. You'll note the shop house on the first floor and the kind of commercial street out front. The living quarters on the second floor. Interestingly, they often had these cock lofts or sort of half floors on the top. And these would, in the worst cases, or the most overcrowded cases, involve workers who would almost sort of rent a timeshare in a given day in a cock loft to sleep. So somebody would be sleeping in there in the morning, someone in the afternoon, someone at night, and it was sort of a rotating cast of people. This was not all Tonglao, of course, but there were examples of this happening. Okay, so in sum then, what I've tried to show first in the article and now in a longer chapter is that demand from in-migration in this period, itself spurred on by a China trade boom, underpinned a medium-run building boom in Hong Kong from about 1865 to 1880 or so. And for me, having reconstructed that history of the boom phase, the question then became, okay, so if the Hong Kong property cycle was actually linked to the sort of broader dynamics of Chinese trade, why did the boom turn to bubble and then the bubble burst 2 years ahead of the concurrent housing bubble in Shanghai, which honestly shared a number of features that I've just described with the Hong Kong experience? And to answer that, I ended up finding it helpful to distinguish between ultimate causation on the one hand, that is, this long-running property cycle, and proximate causation. And to address the proximate causes of the Hong Kong housing crash, as opposed to the Shanghai crash, I've needed to address the career of this man. This is John Pope Hennessy, who served as Hong Kong's colonial governor between April 1877 and March 1883. So in social policy, Hennessy was a conservative Irish Catholic, interestingly, but he was also a free trader. And critically for Hong Kong housing markets, he was a believer in racial equality. So when Hennessy arrived in Hong Kong in 1877, he found that there was a standing order in council that forbid the construction of so-called Chinese premises, aka the Tonglao, in portions of central and the mid-levels that were customarily reserved for Europeans and Americans. Unlike most expats in Hong Kong, the governor, as both a free trader and someone sympathetic to local people, at least somewhat, disliked this restriction. So he ordered colonial officials to relax the enforcement of that standing order in council. And this allowed anyone, really, Chinese or non-Chinese, to buy and sell real estate on Hong Kong Island. This was quite a big deal, and it enraged a lot of the expat community here. They were mad at him for some other reasons, some of his other policies as well, but this really, really bothered people. It also, however, made Hennessy something of a beloved figure here with Chinese merchants, which was the community he was honestly most interested in cultivating. And some of that was for his beliefs about race, but there were other reasons as well. It was not all benevolent. Critics put his policy down to a so-called native race craze, not my term, but Hennessy was in part actually placating what were his most important taxpayers, these newly rich Chinese merchants in Hong Kong. So the trade-cum housing boom of the 1860s and 1870s had made those wholesale merchants and others some of the richest people in the city, to the point that by about 1881, 17 of 18 top ratepayers here, or taxpayers, were ethnically Chinese. This was a big reversal of previous trends. Starting in the later 1870s, these merchants and other wealthy Chinese suddenly had the doors of the real estate market open to them. But those doors swung open at a time when the market was already beginning to transition from boom pricing to bubble pricing. So these Chinese merchants' newfound enthusiasm for speculative property investments was the thing that would ultimately sort of push and speed up the last phase of Hong Kong's property cycle. Okay. Given that I'm ultimately discussing a financial crisis, I should maybe mention real estate finance. And this is the spot for it. So the man on the right here is Lo Pak Chung, the first comprador at the Hong Kong Bank, later HSBC. Low and his peers at the other foreign banks in Hong Kong at the time would play a key role in both financing property development during the boom and in financing asset price speculation in real estate, as well as overbuilding in the bubble. But they did so indirectly. So let me explain the financial system as a whole quickly. As of the 1870s, there were essentially two main parts of the Hong Kong financial system, if we can call it a system. And compradors like Low were the ones who bridged the gap between the two halves of that system. On the one hand, you had foreign banks, such as the Hong Kong Bank or the Chartered Bank of India, Australia, and China, which Gassan has, of course, written about well. And their main business in Hong Kong was the issue and discount of international bills of exchange on London. But they also took deposits, increasingly, and they did a bit of direct lending. And in the boom years, some of that direct lending went to local Chinese banks. These were the Yin Hao or Nan Ho, who were the second portion of the financial system. These were silver houses, so-called, or local banks, whose main business was the issuing and discounting of promissory notes in local trade. But during the boom, they honestly ended up branching out into building and construction loans. Critically, what emerged in the 1860s and thereafter was a system of interbank lending from the foreign banks to the Nan Ho. Local bankers would, through compradors such as Low, borrow from foreign banks at short maturities, and this credit would indirectly sustain real estate finance. What I'm describing for people who know about all this is the so-called chop loan market, which existed in Hong Kong, just like it existed in treaty port cities. Here, local banks bolstered their working capital by borrowing these chop loans and then pass on that capital to the real estate sector through local building loans for housing construction. As of the early 1880s, according to colonial records, there were about 52 of these local banks in Hong Kong, borrowing about 3 million Hong Kong dollars per year in chop loans. And much of that was passed on to traders and to builders. So in the later 1870s, with the easing of the enforcement of the orders in council, rich Cantonese speculators used this bank credit to buy and sell properties, often quite rapidly, particularly properties in central and mid-levels. And in doing so, they sped up the kind of unmooring of real estate prices from underlying fundamentals. The mechanics here were the same as in any asset price bubble, really. Deeds and mortgages were used as collateral for credit that was used to speculate. Then as prices rose, those deeds and mortgages on Hong Kong properties, or even just land itself, would grow even more valuable. And then with this even more valuable collateral, they could get even more credit, and on and on and on, in a kind of exponential upward loop. This in economics is sometimes called the money multiplier effect. As evidence of the money multiplier in Hong Kong, according to the newspaper reports, merchants borrowed in this period from local banks at about 6 to 7% annualized interest, while their expected returns per property sale rose to about 10 to 20%. That's per sale, not on an annualized basis. So crucially here, customary rent increases in Hong Kong at the time were said to be about 3% per year. So the only thing that could keep the market afloat once it entered this bubble pricing period was increasing indebtedness based on asset price appreciation, which kept deeds and mortgages, kept them kind of rising in value. And that, of course, could not go on forever. We do not have, unfortunately, holistic data on this price appreciation in Hong Kong, but we do have a few examples from the historical record. One of those examples was Blue House, pictured here, over in Wan Chai. Blue House appears to have changed hands multiple times, just in early 1881, and each time it changed hands, it earned an additional $10,000 on top of its previous sale price. We also have other listed examples from the Hong Kong Government Gazette, and among these you had whole blocks of buildings whose resale prices would rise 38% in 30 days in one example, or 42% in 30 days in another example I cite in the article. So from January 1880 to May 1881, we know that Hong Kong buyers, or Chinese buyers in Hong Kong, purchased about 600 separate shops, offices, warehouses, and homes from Europeans and Americans for a sum total of about $1.7 million. It's a figure that would almost certainly have been much higher 5 months later in October when the bubble actually burst. Property bubbles, of course, can burst in a number of ways. Sometimes This is due to exogenous factors, as economists say, or external factors. But in the Hong Kong case, the bubble peaked and then deflated quickly on account of endogenous factors, i.e. internal market dynamics. And those dynamics more or less exactly track property cycle theory. Put simply, according to the newspaper reports, when October came, neither rental incomes nor additional credit borrowed at local banks at higher and higher interest rates could cover builders or speculators' costs. The result was that bankers, both foreign and domestic, withdrew all of their loans. So the building loans were withdrawn and the CHOP loans were withdrawn as well. And this precipitated bank runs and then a sharp deflation in property prices. This was a fall in price of about 45%, according to the contemporary estimates of Governor Hennessy's personal secretary, E.J. Eitel, who some of you will know from his period history of Hong Kong, which is itself a useful resource. So Eitel's 45% number is actually interesting because it more or less tracks the 50% average fall in property values for archetypal property deflations. The process was at this point pretty simple and functionally just a chain reaction. So real estate exposed banks suspended, property firms and individual speculators went bankrupt, and absentee depositors at the local banks here in Hong Kong, many of whom were living in China over on the mainland, rushed over to Hong Kong to withdraw about $7 million in deposits, according to the papers. This then had a knock-on effect because those banks were responsible for issuing promissory notes to local merchants. So without promissory note credit, merchants here also struggled to make payments, absent their banking services, and a commercial depression set in. All right, I think I have time to read this. I'll go ahead and just read you a description that I have here from the Hong Kong Telegraph in 1882, just to give you a flavor of the reporting at the time. So the Telegraph reads, confidence in the stability of the Chinese mercantile community has been so rudely shaken by recent events that general business interests cannot fail to be prejudicially and permanently altered. For some considerable time past, the panic, which has at last set in, was inevitable, and those who have not taken the precaution to be prepared for the bursting of the bubble have only themselves to blame. The trade of the colony has been suffering for months from the disastrous results of the so-called house property business, and we are much afraid that the worst has yet to come. The dazzling prospects of the speculation in houses and land have ended in hopeless ruin to a very large number of wealthy and influential Chinese firms. Chinese banks have stopped business, and trading homes have put up their shutters. It will be years before the colony can recover from the effects of this discreditable chapter of reckless infatuation. It's a bit purple, but it captures the time. In my article, and even more so in my book chapter, I cite specific examples of property transactions gone wrong, including a failed sale of the Hong Kong hotel. Just for the sake of time here, I won't list them, but suffice it to say that there were a number of leveraged transactions that fell through when Chinese property buyers suddenly lost access to all of their credit, those bankers themselves having lost access to CHOP loan credit. And many of the defaulters ultimately found themselves in bankruptcy court. We do not have complete bankruptcy records, sadly, but what we do have shows that the balance of the surnames in those bankruptcies pretty much immediately shifted from expat names, German surnames, English surnames, Parsi surnames, to Cantonese surnames after October 1881. Okay, I'm coming to an end here, but I want to mention at the end here one episode from the Depression phase of the cycle that I find quite interesting. And that was a public meeting at City Hall in Hong Kong on June 10, 1882. This was chaired by the man on your screen, Ho Ame. So Ho is pictured here about 20 years before the crisis when he was living in Australia. But by the 1880s, he had returned to Hong Kong and become perhaps the sort of most prominent bilingual businessman in the city. At the 1882 meeting at City Hall, which was attended by more than 100 of the wealthiest merchants in the city, Ho essentially held court. And I honestly found his descriptions in his meeting, or reports of his meeting, I should say, quite helpful in reconstructing a lot of the history I've just described. In the meeting, Ho eventually secured agreement from all the merchants on 2 resolutions that were supposed to be passed on to the colonial government. The first of these was a resolution that urged Hennessy to pressure the Hong Kong Bank and other foreign banks to immediately renew their interbank lending facilities. I find this fascinating because it shows just how essential this sort of back-end financial plumbing, as people say now, was to the real economy. The second motion passed was even more interesting in that it was a resolution that essentially requested a bailout from the government for property holders. Specifically, Ho and other merchants formally requested from Hennessy that he advance state funds to Hong Kong property holders at as loans, basically, at 5% interest. This was below market rates and thus would have functionally been more of a bailout than a loan. And they asked to do this against their own distressed mortgage collateral. Both petitions were very much not in keeping with the laissez-faire attitude of British imperialism at the time and to Hennessy's own free trading instincts. But it sort of wouldn't have mattered because, as Hong Kong historians have taught me, the fiscal situation here, part of the reason that Hennessy and other governors relied so much on Chinese merchants was that London didn't want to shell out a lot of money to finance the running of the colony here. So there wasn't a lot of extra money that could have actually been lent out to these property holders at below market rates. But either way, it's an interesting episode that I recount in the book, and it's pretty indicative of the crisis as a whole. Unfortunately for the petitioners, all they could do, as so many people had to do in 19th century financial crises, was just to wait out the Depression and wait for the next cycle to begin. Let me close here by highlighting a couple of key points. So first, I think based on the second half of the talk I just gave, it can be tempting to recount the history of John Pope Hennessy's housing policy in Hong Kong and mistake the 1881 land mania for a purely policy-driven crisis. As I've tried to show, I think it's better to understand the crash as a sort of medium-run property cycle whose bubble and top phases were accelerated by the easing of the enforcement of the Order in Council. However, the panic very likely would have occurred anyway, or in a different form, just a bit later, perhaps even concurrently with the 1883 crisis in Shanghai. This is obviously a counterfactual. I can't prove this, but it's my suspicion, having been in the historical record. Second, this was a real estate boom bust tied in part to the China trade. And as such, I think it should be seen as sort of the opening salvo of this wider 1880s Qing financial crisis, just as the most informed observers viewed it at the time. It was both a kind of crisis in miniature, an omen of what would play out on a larger scale on the mainland, but it was also a crisis that was fundamentally linked to the broader cycles of trade and urbanization going on in late Qing China. As for Hong Kong itself, the mania, as far as I can tell, continues to be an overlooked moment in Hong Kong history, but it was not overlooked at the time. Both Hennessy's personally and the crisis itself were top of mind, for example, in the late 1880s, when the Legislative Council here in Hong Kong passed the colony's first formal ordinances that reserved properties on the Peak for European owners, the earliest of many subsequent redlining measures in the city. For that story, I would again recommend Professor Chu's recent book. Okay, thank you for your patience, everyone, and thank you for listening. We can open it up to questions.
Yeah, Bill, thank you so much for the great talk. And as you mentioned, I can also recommend everyone to check out your recent article in Business History about that, as you said, goes into somewhat more detail. As I said, we have now some time for questions. So if you have any questions, please submit them through the Q&A button. Through the Q&A button in Zoom, and then I will read out the questions for Dr. Kelson to get back to. Well, maybe I can get us started. I mean, of course, we are talking about Hong Kong today, but I do think that in the article, and you mentioned this briefly, you do talk about Shanghai as well. So I was wondering whether, probably for the benefit of the audience and everyone, I mean, because I really like this kind of comparison, how you put these two crises together in the article, whether you can talk a bit more about, how this compares to what is going on in Shanghai and what connection there might be between the two crises.
Sure. The comparisons people made at the time was that they would, particularly I'm thinking about like merchants at, or like merchant managers at Jardine Matheson, and a lot of local newspaper writers in Shanghai were looking at the Hong Kong experience. And they mistakenly thought that Hong Kong had a housing bubble, whereas Shanghai had a stock market bubble. But what actually was going on was that Hong Kong had a real estate bubble and Shanghai had both a real estate bubble and a stock market bubble at the same time. A lot of the bubble pricing that was happening in Shanghai just a couple of years later. And the specific structures were not the same. The Tonglao were very unique to Hong Kong and the building boom. But people who've spent time in Shanghai and know the city's history will know the Shikumen housing, these kind of narrow lane housing structures of the time. In the same way that the Hong Kong building boom was the Tonglao boom, the Shanghai boom was the Shikumen boom. And you had the same chop loan lending from the local banks there that they were borrowing from HSBC and other foreign banks. But in the Shanghai case, it was actually worse because the local Qianzhuang there, the local banks, they were borrowing chop loans, but they were also borrowing interbank loans that were quite similar from the Shanxi Piaohao. So you had two-way interbank lending that bolstered the working capital of these Qianzhuang, who then passed that on to these kind of merchant developers. But when the bubble came, you get the same dynamics of the housing gets shoddier and shoddier, and there's a lot of complaints in Shanbao about the kind of poor quality of the construction. You get new neighborhoods that are built a bit ahead of the actual demand, even though you're getting a lot of in-migration to Shanghai. And then when the bust comes, it's worse in Shanghai because you have the Shanxi Piaohao, who have empire-wide banking networks, and you have a bigger bubble because you have bubbles in stocks and in real estate, and then the crisis spreads. That's a potted version.
Yeah, thank you. No, I think it's just an interesting contrast, I think. Okay, we've got our first question that comes from Professor Yendong, and he says, great talk. One question: where did these Chinese merchants get the idea of having the government step in and bail them out? Was it born out of previous experience from other crises, or more of a Hail Mary move? Thanks.
That's a great question. The simple answer is that we don't know. I think it's probably more of a Hail Mary move than previous experience. So Walter Bagehot's book about famous book Lombard Street about lenders of last resort and having the government and particularly central banks step in crises in this way as lenders of last resort is published in the 1870s. So it's possible that Ho or English merchants in the city would have been familiar with this idea very generally, but I find it unlikely that Ho Ame was reading Walter Bagehot and explicitly thinking about his calls for the government to step in as a kind of lender of last resort. So it probably was more of a Hail Mary, but they didn't. Ho doesn't say in the record, I read it somewhere or I got the idea from some English merchant.
Right, thank you. Do we have any other questions?
Sure. If I can jump in with a question, Bill, how should we understand this episode in the context of the monetary systems that Hong Kong and China adhered to or followed at that time? In particular, I'm thinking about the continued adherence to the silver standard in Hong Kong and of course China. And would that have would that have affected the way money flows and credit markets worked at that time, and perhaps had an outsized effect on the speculation in Hong Kong and then later Shanghai at the time?
One of the things I found interesting in researching the crisis on the mainland is that it spread to both copper base and silver base monetary system. So it spreads to Tianjin in the north, it hits Beijing, so less silver dollar based parts of the country. And the other thing I'd say is that people are probably familiar with this story of silver depreciation against gold in the global economy in the late 19th century. That doesn't really kick in any kind of steep way until after the crisis. There's a very slight depreciation of silver against gold in the 1870s, but it's quite minor And if it did anything in the boom period, it was to make Chinese exports slightly more valuable. So if anything, it may be slightly enhanced. It's hard to say exactly based on the data we have. It might have slightly enhanced the export boom, but there was nothing specific about currency markets that was the driver of either crash in either city.
Yeah, I'm just thinking perhaps the abundance of silver on the part of the foreign banks made them a little bit more loose in their extension of credit to the Qianzhuang and other Chinese parties. But yeah, looking forward to seeing the full-blown research, the book that this would be part of.
Yeah, to your point, that the foreign banks were definitely lending their idle silver funds. That's where this chop lending is coming from.
Right.
But it's hard to establish with any concrete certainty how much they were keeping in Hong Kong or in Shanghai versus how much they were actually shipping around to other branches or to London at the time.
Sure. Thank you.
Yeah, Bill, can I actually come in on that? I'm interested because I've written about it myself for a later period about the whole chop loan business. Did the whole crisis did that lead to at least a temporary rethinking by foreign banks of giving these loans to Chinese banks? Because so I'm thinking about the 1910, 1911 kind of rubber boom crisis in Shanghai that happens. Well, obviously happens, three decades later, and that at least for a bit of time kind of stops the whole chop loan business. It comes back there later as well, but I was wondering whether, how did foreign banks think about this whole crisis, and be that in Shanghai or Hong Kong, or did they think maybe we should not give money so easily to these Chinese banks?
Yeah, that's a great question. From the foreign bank's perspective, they were actually pretty low risk because it was not a huge portion of their business, and the foreign banks had fairly large reserve funds. So when the crisis hit, they could either draw down reserve funds locally or across the bank. And it was not a huge share of their business, whereas it was a huge share of the local bank's business.
Mm-hmm.
So eventually they did restart chop lending. The example that we have for the Hong Kong case is the Hong Kong Bank, which very, very prudently got out of the chop loan market right before the crisis came. So you'll know the Oriental Banking Corporation that was here in Hong Kong, the OBC. They had gotten into financial trouble elsewhere in Asia, and they were looking to get higher returns. And so the Hong Kong Bank managed to kind of sniff out that the bubble was about to burst. And about a few months before the crisis came, as they said in the HSBC correspondence, they transferred their chop loans to the OBC, which is to say that they left the market and the OBC filled the void by taking over their clients. So when the crisis came, one of the most prominent things that happens is that the comprador at the OBC absconds and disappears with a lot of money, and the OBC goes bankrupt. But in a way, the crisis solidifies HSBC's position, both in Hong Kong and Shanghai, because it's the bank that comes out of the crisis in the strongest position. And it eventually, ironically enough, takes over the Oriental Bank's business, both in Hong Kong and in Shanghai. From the Chinese perspective, particularly in the mainland case, the problem of the risk associated with chop lending was a big subject of debate, and it was part of behind the push by wealthy people there to try to get Chinese people themselves to have their own joint stock banks. Mm-hmm. So in a way, the crisis is an impetus for the formation of these early Chinese joint stock banks that are not the Qianzhuang or the Yinhao which were unlimited liability proprietorships or partnerships, as opposed to limited liability joint stock banks.
Mm-hmm. Yeah, that's true. Yeah, interesting. Do we have any other questions? Now is the time to ask. All right, but I think if not, then Bill, let me thank you for taking the time to give us a talk and to introduce your research to us. As I said, please everyone check out the business history article that Bill recently published on this, but also we're looking forward to your book very much, of course, and to hearing more about about your research in general in the future. And so thank you very much, and thank you everyone for tuning in as well.
Thanks, everyone.
Thanks,
All right.
Bill.
Thank you.
Bye-bye.
Bye.
Right.